Everyone see it okay still? Yeah, okay. Well, we'll move further then. All right, so part A, we're going to calculate the duration of net worth. So let me pull over my already finished version so I don't mess it up in front of you guys. So first thing we want to do is take our duration of assets, which we can get by taking our 200 in cash, 200 in cash, and dividing it by our 1,000 in total assets, multiplying that by 0, which is our duration of cash, and then taking that, I'm going to add it to my 800 in loans and divide that by my 1,000 in my total assets. And that's going to come out, oh wait, then I'm going to multiply it by 3 for the, I think that's the duration of loans again, right? Yeah, that's duration of loans. So that's going to come out to 2.4 for my duration of assets. Then from there, we're going to take that and put it towards our duration of net worth equation. So to finish out, let me move this over here, and then I'll see it. And then for our duration of net worth, we take our 2.4 over here, and I'm gonna subtract that from my 900 in debt divided by my 1,000 inside of my total assets, multiply that by 4. I get that off just because I can. And then I'm gonna multiply all of that by my leverage. Does anyone remember what leverage is? How to calculate your leverage? No? Not a soul? Okay. I don't either, so we're just gonna kind of sit here, I guess. I'm kidding. It's gonna be your dollar amount of assets, which is 1,000 in this case. And then our dollar amount of net worth, which is 100. So it's gonna come out to -12. So our duration of net worth is -12. I think it drains. That's pretty. Okay. Okay, so with that, now we want to find our. Then we want to find the expected net worth if interest rates fall 200 basis points. So I'm going to find my change in net worth, which is going to be our duration of net worth times our fall of 2 basis points. And I have to make that first one negative really quick, but yeah, that give me a second. That should be negative.
Anything to add there?
Oh, that's negative.
One adjustment.
One adjustment for me?
Yeah.
Let's all look at it together.
What's the formula?
Yeah, I must have. Or well, you see mine. So I took my that B1, that's my duration of net worth of -12.
Might have it. Yeah, okay, so you fixed it. All right. So
Oh yeah, I missed the negative at the beginning. I want to put it back in.
see it. There's
Is that what you're talking about?
so right
Yes.
fall.
Can you show the
Young gentleman.
For A.
For A? The formula's, oh yeah. Yeah, like that. Oh, not like that. Okay. Here, there. Okay. All right, so part C.
Now on B, just make sure, so be real careful. So I'm letting you do it like that. So you can see the question doesn't ask what was the percentage change in net worth. It asks what would net worth be afterwards. So we're saying net worth's gonna fall 24%. So what's his net worth gonna be? It started off at 100, so what's it gonna be after rates fall? You can do that in your head, right? So 24% of 100 is 24, so that works to be 76. But make sure you give me not just the change. I'm asking for the actual net worth, not the change in net worth. And remember, this question B has nothing to do with the next question, so students get really confused. I think in the exam, I don't know if I did there. Yeah, in C, it says independent of question B, so they don't get confused. So B is just a question, and the other two double following minus duration times the yield. There's nothing else to that question than that. So you just ignore that question after you do it. All right. So your net worth is 100, not 1,000, but yeah.
That was one of my intentional mistakes, of course.
So 100 times negative 24. So and you add that to the 100 and you get to 76. I don't think a whole lot, but just read the question. It doesn't ask how much you ever change, it asks what's it after that.
So,
All right, good.
ready? Okay. So part C is independent of question B. If the bank's board has the following constraints on the volatility of its net worth in relation to the interest rate changes, what actions does management need to take, if any? So we can see any movement in our basis points on our interest rates. So a movement of anywhere from +2 to -2% impacts their net worth by that much. You can see the spread up there. That's our stress test. So for this, we're going to need to use an interest rate swap. So that's decreasing our duration of liabilities. You can increase your duration of assets as well, but that is difficult. So increasing your duration of liabilities using a swap is way easier. And any notes on that? Because I just kind of agree.
No, that's good.
Okay.
So
Not oversimplification.
So how do you handle that board? So in that case, question B did have 200, which is one of the board's constraints, 200. Rates fell to 200, let's say your net worth can't fall more than 12%, it actually fell to 24%. So we're out of compliance. You can talk about that. And then I would put the full answer in, it's in the notes, the safe Carson time should enter. So yeah, you can increase the duration of assets or decrease the duration of liabilities. We have a little bit more discussion in that. I'd increase the duration of assets, you can do longer term loans. You can do, the liabilities can be shorter term CDs, those are all things that disrupt operations. The swap is the one thing you can do without disrupting operations. You can put all of that to your answer, that's in the notes. But the more thoroughly answer, the more credit you'll get there. Carson doesn't need to do all that because it's kind of time consuming, but yeah.
And then for part D, we want to find what duration of net worth would be acceptable for the board given the constraints above. So given our stress test indicates that we can't go past 12%, we want our duration of net worth to be taken from -12 to at least -6. Yeah, to -6. So that way any change in interest rates doesn't push us past that -12 point. So the answer is 6. Yeah.
I used to do duration in years. I've had that debate. You need duration in years, 6 years. I've had someone say it's not years, but if it's not years, I don't know what it is. They have assigned maturity. If those aren't years, tell me what it is. So years is the right answer. All right, good. Doing well so far.
Nice. All right.
And I was gonna fix the problem with swaps. You can do some.
Are there swaps on this page? Okay. Keep an eye out because this is where I threw in all of my intentional errors for you guys to find. So, all right, starting off, we're going to determine which company has the comparative advantage on our fixed rate debt. So if we look up here, we can see that we have a difference in our treasury AAA. Oh, wait, somewhere out of the way. AAA has the T plus 20, and then P has the T plus 300. What's the difference there?
We can do that.
Oh yeah, because the T.
Difference.
Yeah, it's a difference of 280. So 280, yeah. So that means that our comparative advantage for so AAA has the advantage on this fixed rate here. because triple B has to pay that 280. And on the floating, we see that triple A has the SOFR plus 10, and then triple B has the SOFR of plus 60. So here we see that triple B has the comparative advantage on the floating rate, and triple A has the comparative advantage on the fixed rate. So then for part A, we know that triple B is going to have that floating advantage, or wait, is going to have that triple A is going to have that fixed rate comparative advantage. Yeah.
One type of differences over there in G, just type 280 and 50 over G.
280 and 50 over in G over here.
Yeah.
280 and then 50 differences.
Remember that wherever the number is bigger, where triple A has the advantage, where smaller, triple B has the advantage. What's 99% of the time? And fixed demand. Well, that's a lot, remember the term structure of debt, credit spreads, term structure. And higher quality companies tend to have a bigger advantage longer term than short term. So, ways. I've had some, I think we did one problem class with the switch. I'm unlikely to do that because that's just too weird.
And then for part B, it's scroll. Can y'all still read that? Or is that too big? Can y'all still read it? Yeah. Okay, cool. Yeah. And then for part B, it's going to be calculate the ultimate borrowing costs for triple A and for triple B if these two entities borrow in the markets where they have their comparative advantage, and then enter into a fixed rate floating interest or a fixed for floating interest rate swap agreement where triple A receives that 125 or treasury plus 125 basis points from triple B, and then triple B receives that SOFR rate from triple A. So I did this one on paper, so I'm gonna write on the whiteboard really quick. Good, Marcus. I can do it myself. Yes, it's okay. I was doing.
You maybe could show them on the. It won't be on the video, but show them here.
Yeah.
Where's this file located?
Where's this file located? This file is located under your exam questions. It's balanced immunization. So here, ignore the chicken scratch. Sorry, guys. We're all gonna suffer here. But that's good. I just won't go through it all. So AAA, all right, AAA is going to pay out the treasury plus 20, which I can't show you because they're there, but it's going to pick up that treasury plus 20 to our floating rate or to triple B. So that's the fixed loan rate. And then it's going to receives the T plus, so treasury plus 125 from the swap. From swap. And it's going to then pay the SOFR from swap. From swap. So that's what AAA ends up paying. So their net cost comes out to our SOFR rate minus our 105 basis points. And we get that 105 from taking the 20 out of our 125 treasury rate. And that is our, right here, this is our net cost for our swap, net cost of swap. And then for triple B, they're going to pay that SOFR rate. So pays SOFR plus 60 And that's going to be their floating rate. So up here, notice how we did the fixed rate. This is going to be triple B is paying the floating rate. Floating rate for the SOFR, so SOFR plus 60. And then it's going to receive the SOFR rate from the swap. And it's going to pay that Treasury 125. 125. That's from the swap. So their net cost is going to come out to 185 or T plus 185. And that's from that's 60 taken out of the 125 right there, or added on to the 125. So getting us that treasury cost of, these are all in basis points. T plus 185 basis points. So treasury plus 185. Thank you. Appreciate it.
All right.
Anyone spot the
280 minus 50s, so we had 230, that's not 230, 15. They started off at LIBOR plus 10, now they're LIBOR minus 105, 10 minus 115. Y'all see how to do the math. You know the answer even before you start the problem. You do that difference correctly up front. All right, good.
Cool. Start burning your tongue.
I have one question. So the duration of assets.
Mhm.
You use
The formula?
3 for the duration of debt.
Okay.
0.4.
Yes. Okay. So over here, let me highlight this as well. So it's a little easier for us. So duration of assets. Let me pull up the formula really quick. Does anyone have the formula up on the notes, on the class notes? No. Okay. Well, we have our 200 of our cash assets, and you were asking why use 3 there?
Oh, I'm sorry, I had different numbers. Yeah.
Oh, no, you're good.
The duration liabilities was 4. That's what he used.
Wait, I used 3 up here. Yes, what are you talking about? Oh, for my duration of net worth.
Yeah, he used 4.
He was asking about my duration of assets and why I used the 3, I think. Anyways. Okay, so now that we have part B, which was the most complex part of this, so. Okay, so for part C, refer back to X. So we're referring back to that company we did in the first question, and we're going to determine which side of the swap transaction they should be on in order to immunize their balance sheet. Anyone have any guesses? It's 50-50 chance, so you're either with AAA or triple B. Might have put it on my notes. You might already have that. Okay, no, you can see it. No guesses? Okay, so they're going to want to take AAA's side. And that is because AAA has the advantage on the fixed rate, which allows them to decrease the duration of their liabilities by more than it would with the floating rate, because we want to take the fixed and end floating, right? Yes, yeah. So we're gonna start with the fixed rate with AAA, and then we're gonna end at floating, so that we're getting paid out that SOFR rate with the 105 basis points, right?
You might set this up when you do the question in the previous part. You say, what do they need to do? So they need to reduce the duration liabilities. So if they do a swap, they should be in a swap that starts fixed and floating. That if you write that in the first part, when you get to the second part, you're no longer confused. Which entity started fixed? Well, that's always me for AAA. Which entity is floating? That's always me for AAA. Which if you need to increase the duration of liabilities, then that's probably me for B. You can kind of memorize some of these. As I like to have AAA having an advantage in floating, they're going to have an advantage in fixed. So you can somewhat set it up in that first part of the question. So I can see some of y'all haven't really practiced the problem once you're looking at kind of blank stares. So you just have to work problems over and over again and get used to them. You have the videos of the problem we work in class. And I'll give y'all some more that you can practice with, but it really doesn't matter just doing it over and over again to get be second nature.
Okay, part D. So now we're going to use our dollar duration gap analysis, which is that easy formula that everyone should already have memorized, as he was telling us. So it's going to be for duration gap analysis, it's going to be your duration of assets times the value of assets minus your duration of liabilities times the value of your liabilities. So when I say value, those are your dollar values. So we're gonna right now. Does anyone want to do that formula for me? No, here I'll scroll in. Just do it and bring it down here. Cool. Okay. So we have our duration of assets, which is going to be 0.
No, just use the
2.4.
You did before, use your equals sign. Yeah, you've already calculated.
Oh, I see what you're saying. My 2.4, and then I'm going to take my 2.4 and I'm going to multiply it by my value of assets, which is 1,000. And I'm going to then subtract my duration of liabilities, which is there at face value. That's going to be just 4. And you see that right over here under our duration section. And then we're going to multiply it by our value of liabilities, which comes out to 900 on the debt side. And that should give us negative, and this is in millions, so negative 1.2 million. Yeah.
1.2 billion.
1.2 billion, sorry. Yeah, in millions. 1.2 billion, and then we're gonna take that. And as you can see in part D, so we're using dollar duration gap analysis to see if the bank were to offer a 6-year duration interest rate swap, what notional amount would we want? So since our swap duration is going to be 6 years, we're going to divide our, actually, let me move this so you guys can see it. We're going to take our duration gap analysis and we're going to divide it by the duration of our interest rate swap, getting us 200. And don't take that at the face value. That is, it does say negative 200. But what I mean by that is that it's going to, because we took AAA aside, right? So they're going to receive the fixed rate price times 200, and then pay the floating times 200. And that's multiplying by their basis points, right?
Well, by the swap, yeah.
By the whatever the swap is at. Okay.
All right, good. You don't need to do
I don't need to do any.
essay. Yeah, okay. Very good. All right, thanks. It's kind of nerve wracking, right?
Yeah.
So just to be clear on here, this 1.2 billion is the dollar duration gap. That is the dollar duration gap, that 1,200. This is the notional put in the swap. And you just do the absolute value of that. Why? Because you've already made the decision up above whether you're doing floating for fixed or fixed for floating. That's what the negative means. The negative means you're going to pay floating, receive fixed. The positive means you're going to pay fixed and receive floating. But you already just said that in the previous question. So it's just 200 million bucks. So the dollar duration gap is 1.2 billion. And given that you have a 6-year duration swap, you need a $200 million swap for your notional. So that means you're going to pay T plus whatever it was for 5 years. It's in there somewhere. So you're going to pay, they're going to receive treasuries plus 125. That's going to be fixed for 6 years. They're going to receive exactly T plus 125. If treasuries are 5%, they're going to receive 6.25% over the next 6 years. And then they're going to pay LIBOR which is going to change every quarter times 200 million over the next 6 years. When did they pay the 200 million?
You said pay library? Or
Yeah, they're going to receive treasuries and they're going to pay, I'm silver, I'm sorry, SOFR. So I'm still in the old world. I retired when it was still LIBOR. I retired right in the controversy of LIBOR. So it was just blowing up during the 2008 crisis. All right. So they're going to pay whatever that is. So at that second that you do the contract, whatever treasuries are, that plus 125, they're going to pay that for the next 6 years fixed. If treasuries change, that doesn't change, whatever that starting point is. But they're going to receive, they're going to pay LIBOR. So they're going to receive treasuries plus 125 on AAA side. They're going to pay LIBOR or SOFR. Every time SOFR changes quarterly, that's going to change. Now, what did they actually do? They actually net it. So whichever number is bigger, that's what gets paid. So if T plus 125 is larger, then AAA is going to receive money. If T plus 125 is smaller, then AAA is going to be paying. So they actually net it. You don't switch back and forth. There's really no need to do that. So practice it. You just got to practice it. Do the same problem over and over again until you get really comfortable with it. It's really not, the math is easy. The formulas aren't difficult. It's the concept to understand exactly what you're doing. I just talked to an alum who's in this business. And he says, yeah, that's the problem I remember because I see it all the time. So it's out there. He also said the most useful project he did in undergraduate, you want to guess what that might have been? Paper 1 in this class, because he's in that field. And he was like, yeah, that really set me up. So it's a tough paper, but boy, it does really set you up. But yeah, he's seeing this kind of stuff and he's in the industry where he's actually monitoring these type of things. Really interesting. He's doing well. So any questions on this? So I'll get you a few more examples out there that you can practice, and then maybe I'll solve some of them by YouTube before the exam so you can practice. But really, really useful stuff. This is what banks do. This is what Silicon Valley Bank was not doing. And what does Silicon Valley Bank do? They said, wow, the yield curve is really steep. Why don't we go out further on the yield curve and buy some higher yielding investments? Why is the yield curve so steep? Because rates are expected to rise. What killed Silicon Valley Bank? Interest rates rose. So not a smart move on their part at all. What was the duration of net worth? It must have been like 8 or 9 years, 10 years. It was way out of whack what it should have been. A huge, huge mistake. So, all right, good job. I'll save it just in case. Put it out somewhere. I'll just call it Carson 1. I should do like the guy named Excel files they had for me. He called them Ron Dude 1, Ron Dude 2, Ron Dude 3. I should have done that.
What should your ideal duration of net worth be?
It's whatever the bank wants it to be. If they think rates are going to fall, they're going to go up further. If they think they're going to rise, it can come in shorter. So there is some of that, but they're going to stay within the board limits. They're not going to go out crazy. All right, so we were talking about this idea of borrowing money so that you can invest it and make more money. So borrow at 4% and invest in the stock market and make 8%. The arguments we said there, first of all, when you borrow money, your beta goes up, makes your firm riskier. When you borrow money through a pension plan, whereas you give your employees a pension plan instead of borrowing in markets, you're talking about a very, very high systematic risk. Pensions are very sensitive to inflation, very sensitive to interest rates, which make them very high betas. So when you have a pension plan, the impact on your beta and your cost of capital is even more dramatic. It's a very, very sensitive. And y'all remember the 2 ways you increase the value of a firm? It's really, really critical. It's probably one of the most important things to graduate with. 2 ways you increase the value of the firm. You increase what? Free cash flow by doing what kind of projects? Positive net present value projects. Or you reduce cost of capital. I bet if I interviewed so many students, I bet 98% undergraduate students didn't know those two things, but that's so basic finance.
Is that just the free cash flow over one plus the WACC, that value equation? Not like
Say
the
it again, free cash flow.
free cash flow over one plus your weighted average cost of capital, is that?
Well, that's the value of the firm, but if you increase free cash flow or reduce the WACC, the values can come out.
Yeah.
Yeah, I mean, it's essentially that you have to have the growth rate in there too, but yeah. So yeah, that's basic finance. You either increase free cash flow, and the guy who spoke to this class, he said, a lot of people forget the second one. Everybody's focused on increasing free cash flow. You can increase the value of the firm by reducing the WACC. So increase free cash flow by doing positive net present value projects. What's the net present value of investing in the stock market? 0. What's the net present value of investing in a bond portfolio? 0. Why? Because unless the market's just radically mispriced, you're going to get the expected return. That's just the way markets are built. So doing a pension plan, borrowing from your employees, that makes the beta of your firm go up, your cost of capital go up. Now you're destroying value because WACC is going up. You put it in the stock market, what happens to your free cash flow? Nothing, because you're going to get exactly your return. So you just destroyed the value of your firm. Let's look at this pension liabilities. Y'all remember the 4 things that drive a pension liability? See how much y'all remember. Longevity. You worry about the people are going to live way too long.
Anti-selection.
Anti-selection. So the sick people do what? Take a lump sum. They have healthy people take the pension. Do you think that happens? Absolutely. That's for me for Social Security. I'm going to wait till 70. Why? Because I get a much bigger Social Security because I'm hoping to live longer. The third one,
Inflation.
Inflation. Most pension plans and Social Security have cost of living adjustments. And then the last one, interest rate, which is the biggest one. And that's what I want to talk about here. So there's a couple things I want to talk about. And this gets back to Arnott's paper. We'll talk about his article. So Arnott's article is really complicated on this point. I could show it to you and show you just how complicated it is. I think it's hard for me to say anything negative about him because he's one of my favorite writers. But I think he went a little too complicated on this. There he is right there, Robert Arnott. You remember what he's famous for? Have y'all heard of fundamental indexing? You also look that up, fundamental indexing. He's the fundamental indexing guy, the smart, have y'all heard of smart beta? He's the smart beta guy. So Victory Capital started a smart beta fund, but he has this chart here where he's showing what I want to show you, but I think it's way too complicated. He's taking every cash flow in the pension plan and he's saying this blue line, this is how much cash. So it grows over time because more people retire and then it starts shrinking. Why does it start shrinking? Because people are dying. That's what we call the ABO. That's your pension plan if no new benefits are accrued. This is what you'd have. You just stop the plan. So it increases as more people retire and then it decreases as people die. The yellow line, though, is the present value of the blue lines. And you put them both in the same chart, which I find really difficult. But what do you notice? The yellow lines are bigger. Why? Because, and this is a percentage of the total, not in dollar amounts. That's just the time value money. The cash flows way out in the future are really small. Why? Because when you discount that many years, you get a really small number. I think it's too complicated. So what I'm going to do is something really bizarre. I'm going to do this exact same thing, but I'm only going to pick 2 cash flows. One that's really early and one that's really late. Okay, a real early cash flow and really late cash flow. Just to make it simple. All right, let me show you how I do that because I think this really explains it really well. And you'll see it's the exact same thing I did here. I've got 2 cash flows, one that's going to be paid in year 3 and one year 50, and they're both $500. Okay. So I'm going to build this from scratch, undiscounted cash flows. This is year 3, year 30. And I can't type, so undiscounted. And let's just say, it's a weird pension plan, isn't it? You have two employees. And one's retiring in 3 years. He's going to get a monthly check for $500 and he's going to die. Another employee is going to retire in 30 years. He's going to get one monthly income, $500, and he's going to die. And that's the entire cash flow of his pension plan. Really simple pension plan. All right. Percent of the total. Well, you're expecting to pay out $1,000. So 50 divided by 1,000, 50%, 50%. All right. It's really simple. But now we need to set up the liability. And we need a discount rate. Let's say, I forget what I did in the example. Let's say our discount rate is 7%. So what's the present value of $500 in 3 years discounted at 7%? And this you can do in your sleep. You could do this your freshman year, couldn't you? Someone, I'm scared to ask. Should I just go down the line here? Everybody knows this answer, right? The present value of $500. Y'all did this on the fact exam, didn't you? Someone yelled it out. No PV functions. Like Bill Gates was never born. So what is it? Y'all know this. 500 divided by what? 0.07 raised to the what? Surely y'all all know that, right? Present value of cash flow. Y'all done that. I wish I knew how many times I've done that in my career. It's got to be in the millions, especially with Excel spreadsheets that go on forever. Y'all do know this, right? You're just joking with me. You know how to discount a cash flow. So that's 408. Is that the same answer I got over here? Looks pretty good. All right. Well, now you can really disappoint me and scare me, probably on purpose. What's the present value of $500 in 30 years at 7%? Just sell it out. Let me know that you're alive. I'll pay $10,000 if you get it right, unless I change my mind later. So how much is it? What's in the numerator? 500. What do you do? All right, good. Is that going to be a bigger number or a smaller number than 408? A much smaller number. This is real key to what Arnott is going to say. He's going to say the cash flows are the same, but the liability is dominated by the short term. 86% of it is the short term. Only 14%. Now here's the question Arnott asked. Which of these cash flows, liabilities, which is going to be more sensitive to changes in interest rates? So another way to ask, which of these cash flows has the higher duration? What would you guess on that? The 3-year cash flow or the 50-year, 30-year? Which has a higher duration? 30-year. It's about 30-year duration, right? Because it's the only. So it has a higher duration. So which has the higher interest rate sensitivity?
3-year.
Higher well, let's calculate it, because I'm gonna guess it's gonna be the 30-year. Let's say the liability changes so that the discount rate goes to what I say, 5%. What if the interest rates fall? First of all, what is the liability going to do if interest rates fall? It's going to go up or go down. It's going to go up. All right. So 500 divided by 1.05 raised to the third. How much did it go up? Went up 6%. What do you think the 30-year is going to do? Is it going to go up more than 6% or less than 6%? Plus 500 divided by 1.05 raised to the 30th. How much did that go up? 76%. Which of these liabilities is more sensitive to interest rates? The 30-year, much more sensitive. Percentage of the total. He went from 14% of total to 21% of the total. So the long-term liability is much more sensitive to changes in interest rates. And Robert Arnott says that's great news. Why is that great news? You have these two liabilities. One's 86%, one's 14%. Which of them's causing you all your interest rate sensitivity? The one that's smaller. So do you have to do something radical to address this issue? Not really. All you got to do is handle what? Reduce the interest rate risk on that little bit. You don't have to take 100% of our portfolio. We only need to take 14% of our portfolio and hedge that risk, and we can eliminate a huge part of our liability exposure. So that's what he's saying here. Well, he did it here, but much more difficult to read. So this was an editorial in the magazine. This wasn't even a paper. So he wrote it really fast. But I think he's showing the share of the volatility. But if you look at this, so they're equal in dollar amounts when you don't discount them. At 7% versus 5%, you see the liability goes up quite a bit. The liability goes up 16%. It goes up 74, but 50 of that 74 is coming from the 30-year. So most of your interest rate risk is coming from the very, very long term. And so what Arnott says is, and you can even see it in his paper, in his article. And I don't like the way he wrote this here. I don't know why I'm criticizing Arnott. He's a lot smarter than I am, but still. For a start, it means most plans are holding too little in bonds that are too short in duration. I like the way I wrote it a little bit better. Here's the rewritten one. I recommend that you read the rewritten one. Not that I'm a better writer, but I'm trying to help you on the jargon. So for a start, it means most plans are holding too little in bonds, and the bonds they hold are too short in duration. So most pension plans have 5-year duration bonds. That's not going to do any good for that 30-year cash flow. They're not going to be nearly sensitive enough. You need something that is going to handle this risk here. So what could you do? Well, you just did it. Carson just did it for us. We could use interest rate swaps, get a duration that matches the duration of this 30-year. And how much do we put into that? Enough so that it moves exactly in line with this. We're talking on the asset side. So you want to use a swap to get you something that when interest rates fall, it's going to jump up 50 million. But you don't have to do much. You just get a lot of duration. You can use interest rate swaps to do that. And it's extremely powerful. So he says it's good news. The bad news is this 30-year thing is extremely sensitive. It's going to make your firm very sensitive to interest rate changes. The good news is it's only 14% of your liability. And so you don't have to do much. If you take 14% of your assets or you do a swap that represents 14% of your assets with very, very long duration, you can eliminate practically all of that interest rate risk on the long side. How many pension plans do that? As far as I know, there's only one in the United States that does it. In the UK, they do this, but in the United States, this is not done. Questions on that? I do love this chart. It really, really explains the risk. So if you run into the guy from AT&T, you can just show him this chart and show that he should at least He's going to put all his money in stocks. He should at least have enough bonds so that he has something that's going to go up $50 million or 50 whatever, go up $50 if interest rates fall 200 basis points, because that's what that long liability is going to do. And you can eliminate enormous amount of risk for AT&T if he does that. Now, there is another side to this, and that's symmetry. A lot of students leave this out of their essay. But let's take the liability with the discount rate of 9%. At 9%, so when we went to we went from 7% to 5%. Sorry. We went to 5%. Our liability grew 50. If we went to 9%, our liability falls 28. So what do you notice about the symmetry? Is it symmetrical? Interest rates fall 200 basis points, the liability goes up 50. Interest rates rise 200 basis points, the liability falls 28. What's another way of saying this? Anybody remember DC cuts I? What was the first C? What kind of convexity is this? Pension liabilities have positive convexity. It's asymmetrical. They rise more when interest rates fall than they fall when interest rates rise. So they're extremely positively convex, which is another big problem. Wouldn't you rather that they fall more when rates rise and they rise less when rates fall? Wouldn't you like that to be a lot better, right? You love them to be negative convex, but they're very positively convex. You don't need the word convexity on this class, but I just, for people who have my investment class, just to remind you. So there's an asymmetry. Arnott talks about this in his article. Let me find the word. And I didn't find it. It's here pretty quick. I saw it just a second ago. Oh, here it is. But I did two S's. There's an asymmetry. If the long bond yields were to rise, the NPV of the long tail would fall 37%. If rates fall, the NPV rises 62%. What do you call that again? Positive convexity. That's just horrible, horrible positive convexity. We love positive convexity on the asset side, but this is on the liability side. You hate positive convexity on the liability side because it means you're hurt a whole lot more when things go against you than you're helped when things go for you. It's that asymmetry. Which says what to your beta? Increases it even more. You're now even more sensitive. Because what do interest rates do in a recession? They fall. What does your pension liability do in a recession? Rises quite dramatically. So yeah, it's a scary, scary, scary liability. All right. Could you create this chart off the top of your head in Excel? That's what you really should be able to do and be able to explain it, understand it. That's really the level you want to understand a pension plan. But I think he's not recommending what I'm recommending. He's recommending at least address this part of the liability. Get some really, really long duration assets or a swap, something that's going to go up 50 when interest rates fall so you can offset that. That's what he's saying. You can see my answer is immunize the whole thing. But his answer is at least fix that because that's the bulk of your problem and it's only 14% of your liability. You can eliminate 2/3 of your interest rate risk by simply addressing 14% of your liability. And he talks about that in the paper. So when you read the article, you'll see that. So here's my solution. That's not his solution. His solution is just fix a small part of it. I'm like, fix the whole thing. Why not fix the whole thing? And what is that called? It's called balance sheet immunization. You ever heard that before? It's exactly what banks do, right? The same thing. So balance sheet immunization, life insurance companies do that, have been doing that since inception because they have all the smart actuaries. So this was my question, remember, to our actuary: why are you all so different than pension plans? And he said, you guys are idiots. You don't know what you're doing. We've been doing this for years. It's amazing how few insolvencies you see on the life insurance side. They're just really, really good at what they do. So first thing you do is you assess the risk of those liabilities. What makes these liabilities move? And then you try to invest in a way to mitigate those liability risks. So a pension plan, their biggest risk is interest rates falling. That's what really drives that liability. We know we said longevity, but your expectations of when people are going to die is not going to radically change every year. It's going to change slightly. So those other risks don't, even inflation assumptions don't change all that radically over time, and interest rate is the key. So the biggest part of your liability risk is interest rate risk, which, good news is, that's the easiest thing to fix. That's what the swap market does for you. Y'all saw how easy it was, right? Carson show how it's magic, right? You just, how long is that phone call? 10 minutes at the most, and you can mitigate a massive amount of risk. It's really, really amazing. So interest rate is the biggest and the most straightforward one to address. There's really no way to hedge longevity and anti-selection risk. We just don't know any way to hedge that risk. Inflation is a tough one. We handled inflation somewhat by not going quite as long a duration as the liability said, but we won't get into that. Inflation is a tough one. There are hedges for inflation, but they're just not very liquid. If you think about hedges and important, there's a really good book out there on derivatives market. And if I could, and I can't remember the name of it, or I'd recommend it to you. I'd put it on my reading list, but I read it and I can't tell which book I read is that book. But he was talking, he created a lot of derivative securities during his term, and some of them worked really well and a lot of them didn't work at all. And what he said, for a derivative to work, you need hedgers on both sides of the equation. So interest rate swaps work really well because there's people worried about interest rates falling. There's people worried about rates rising. They deal with each other and they both hedge. Currency swaps work really well. There's people worried about the dollar falling. There's people worried about the dollar rising. You got hedges on both sides. Inflation's a little tough. We know a lot of people worried about inflation going up. There aren't as many people worried about inflation falling. So it's hard to find the other side of that transaction. So it's a hard risk to manage. So interest rates is the obvious one, and that's really what does drive the liabilities of liability values of pension plans. So here's my theory, see if you agree with this. The portfolio needs to hold a significant amount in long duration bonds to illustrate the rise in liabilities when interest rates fall, and have positive, very high positive convexity. Interest rate swaps do exactly that. Interest rate swaps give you duration, they give you positive convexity. Capital markets don't provide bonds like that. We don't have that many just long-term bonds, 30-year bonds that provide that kind of duration. However, you can use interest rate swaps, use dollar duration gap analysis, and it really is as simple. Well, it's simple after you do what? You get the swap contract signed, right? The swap contract's the hardest part. Once you get the swap contract signed, you do dollar duration gap analysis. Carson did that. His broker says, hey, I've got a duration of 6 swap. Carson took 1.2 billion divided by 6. He says, I need 200 million of that. So it's not even a 30-second conversation. Broker says, I got a duration, I got a swap duration 10 years. All right, I need 120. And it's that fast. You probably could just send an email. Pretty straightforward. So what does Warren Buffett say about derivatives? They're going to destroy everything. They're poisoned, all that kind of stuff. He hates them. Why? Because if you do it wrong, you mess the entire firm up. You bring the whole firm under. But when you do it right, you'll see the power of these derivatives. So one of the things you're going to talk about with your bank is the use of derivatives, futures and swaps. And I bet your banks that you're looking at do a lot of interest rate swaps, because they're really, really quite powerful. And they love them because you can so quickly fix these risks just immediately because they're very, very levered. That's their problem is they're very levered. A very little amount does a lot. So it means you can cover a lot of problems with a very little amount, but it also means a very little amount that's done incorrectly can blow up and mess things up pretty badly. So I'm arguing that pension plans shouldn't do what Arnott is saying. Arnott says just fix the long-term liability. I'm saying they should hedge the entire pension plan. They should make the pension plan immune to interest rate changes. Why do I say that? Well, and I use this at UTSA, you might try doing this. Federal law requires all the decision makers for a pension plan have only one goal, and that is to benefit the participants in the plan. They cannot benefit the corporation. They can, because right, you're taking your employees' money, it's their money, and you didn't give it to them. You're keeping it to give it to them later. So every decision you make has got to be in their benefit. Otherwise, what should you do? You should just give them the money and let them do their own pension plan. All right. So it should be solely in the best interest of plan participants. I think that argues that you should hedge out all these risks. All right. So let's think about it. What if the AT&T puts all that pension money in the stock market and the stock market shoots up 30, 40%? What happens to the participants? Does AT&T say, hey, you know what? We're going to increase your retirement 40%. Do they do that? They don't do that. What happens to their pension plan? Same thing. Nothing happens. So did they benefit from the stock market going up? AT&T might have, but the plan participant didn't. What happens if the stock market crashes? What happens to participants then? Yeah, because the pension plan can't pay all of its bills. And now they've got the serious problem. It might go to the federal government, to the PBGC, insured. So a heavy allocation to the stocks might end up in the hands of the taxpayers. The pension beneficiaries may get a portion of their pension, but they may lose some of it. There's no benefit to the plan participants if the stock market does well. There's potential horrible impacts on them if the stock market does badly. I'm going to argue that AT&T putting 70% of their pension plan in stocks violates this rule. Now, I tried with my lawyer. I said, okay, well, what if we stick all this money in the stock market and the stock market does well? That means that UTSA is more likely to keep offering a pension plan. So that could kind of benefit the plan participants. He said, no, you can't argue that. And I'm asking, you know, what's going to put me in jail if I make that argument? I couldn't come up with a good reason why we wouldn't be more like a life insurance company. You do what's in the best interest. The best interest of the participants is what? That you pay them their pension. And what's most likely going to get you to pay their pension is you immunize that pension plan so that you're there when you need to pay it. So I actually think a high allocation to stocks violates the fiduciary responsibility. And how important is that fiduciary responsibility? Well, you know, I was running UTSA's 401k plan and pension plan. That's like $7 billion in liabilities. If I make a bad mistake, guess what can happen to me? I can be sued by tens of thousands of employees. You think I want to be sued? All these employees for making a stupid mistake on a pension plan or 401k plan? Absolutely not. So I have a vested interest in getting this fiduciary thing right as well. So you can see it. I had quite a bit of power about bringing this up every time. How is that decision in the best interest of the participants? Some of you are going to have 401k plans that are bundled. I think that's a ripoff for participants. If you have a 401k plan, want to show it to me, I'll tell you if it's bundled or not. UTSA tried that twice. I fought it hard both times for that argument. I could not come up with a scenario where the participants came out better than the company.
Is there any legal precedent or any cases where people did sue because they, sort of pension plan put all their money?
On the pension plan, the problem with suing the pension plan is the person you're suing is probably insolvent. So if you look at the firms that are blown up in their pension plan, the entire firm is going under. So there may not be anything to sue. You can sue the individuals. Those in my PNC class, wanted the individuals have their corporation buys director and officers insurance. So there probably have been some pension plan lawsuits. It'd be interesting to look up, but where they've sued the decision makers on the plan and then the insurance companies had to pay. My issue with that is USA bought $25 million insurance for me. How much in assets did I have? Liabilities? I had $7 billion in liabilities and they gave me $25 million in coverage. I'm like, could you up that a little bit? It didn't seem all that adequate. So I had a strong incentive to get this right. 2008 pension plans lost a lot of money in 2008. It was pretty disastrous, but I don't know how many lawsuits there were. The CEO of USAA, he got sued not on the pension plan, but on the 401k plan. So he is real sensitive to these. So this argument worked really well with him. I knew how to get him all riled up. So that argument worked really well with him. But yeah, you've got the risk. If you make these decisions, you've got that risk. So be careful. You go work for HEB on their pension plan. Just be aware, if you're decision making on a pension plan, you now have personal liability for every decision you make on the pension plan. So you better make sure it's solely in the best interest. I will say on the bundled side, the federal government came close to making that illegal. But that industry is so powerful, they lobbied and it didn't happen. But it was pretty close. I was like hoping they would because I think it's a horrible thing. Our industry loves money. I don't know if y'all know that. They love pension money, they love 401k money, they love making a lot of money off of other people's money. And the plan participant is pretty low down on their list, but where should the plan participant be? Should be number 1, but somewhere in number 47, 48. I don't know exactly what. So this is my belief. You may not agree with me. I believe firms that place significant amounts in the stocks are violating that fiduciary responsibility. The best interest of plan participant is to invest and create and maximize the probability they keep their commitment. That's what balance sheet immunization does. But I got good news. It also increases the value of the firm. And how is that? All right, how do you increase the value of the firm? Increase free cash flow through positive RU, reduce WACC. What does balance sheet immunization do to the firm's WACC? Decreases it. Why? Because you eliminated your exposure to a massive systematic risk of interest rates. So what does balance sheet immunization do to the firm? Increases its value. Not because free cash flow went up, because the present value of those long-term bonds is 0, because you reduce the WACC. So I got good news. You can both put the participant first and increase the value of your firm. So y'all just saw this. Make sure this is in your essay because I think this is really critical. I would be bringing this up in an interview. I don't know how to bring up an interview question, but I'd be bringing this up in an interview question. I think this is so critical. How do you increase the value of the firm? So like Valero sold off Corner Store. Why did I sell off Corner Store? Well, because Corner Store, first of all, on a free cash flow basis, it was being undervalued because it was part of Valero. It should have had a 18 relative and it's getting a 7. But also, Valero owning Corner Store made it more complicated. It tended to increase the WACC for Valero by separating those two firms. Both firms benefited. Corner Store got credit for its free cash flow in a much better way. Valero saw its cost of capital come down because it wasn't so complicated. You're seeing that somewhat now with GE. GE is spinning off all these subsidiaries. GE was so complicated, very hard to value, made its cost of capital much higher by spinning off all these subsidiaries. I don't know if y'all seen what GE's done, but those companies are just soaring in value. So yeah, you can increase value either one of these ways. Buying investments to hedge interest rate risk does the second thing, reduces the firm's WACC because they're not so exposed. And really in 2 ways, right? Because they don't have all that stock, which is going to crash and recycle. But they also have bonds that are going to be going up in value right when the liabilities go up in value. So they really have reduced the beta of the firm and increased the firm's value by reducing its WACC. Questions on this? This is so great. This should be like the first thing you hear in your first finance class. So I need to reteach. I'm not teaching 3013 anymore, but I need to go back and teach it again and start with that on the very first slide. This should be our first slide in the investment society meet. This is finance right here. Someone says what finance does. We increase free cash flow, we reduce risk. That's what we do. That's our entire job for 50 years. So net present value of those long-term bonds of interest rate swaps is 0. So there's no increased free cash flow, but tremendous reduction in the interest rate sensitivity of the pension liability. So it reduces the cost of capital increase. So the same thing again there. So why am I all by myself on this? Me and the actuaries at USAA. Every time I see them, they're like, that was the greatest project I was involved with. And all three of us think that. I saw the head of human resources at her retirement. And she's like, yeah, that was a really great project. Really great project. We're all very, very proud of it, but we were so by ourselves. I had nightmares because remember what I said before risks were that are not talked about: peer risk, asset risk, ALM risk, and what was that fourth one? Career risk. Unfortunately, in our industry, career risk is often not doing what's wrong, it's doing what's different. So career risk is often being different than everybody else. And our pension plan was radically different than everybody else's. So I was actually probably increasing my risk of being sued because at least on the other side, I could say I was doing what everybody else was doing. My benefit was we had a CEO that if you told him no one else was doing this, he said, yeah, well, let's do that. He liked being unconventional, but boy, it was risky. So why was I all by myself? The three of us at USAA worked on this project. First of all, it's historical accounting. Historical accounting, GAAP accounting hid most of that volatility. Made things much smoother. Essentially what they did, all that volatility for interest rates, they just spread it out over 40 years. So you just didn't notice it. There were actually years where firms lost, $300 million of their pension net worth, but they were booking pension gains on their income statement because of how all this stuff got spread out. A year where they lost $300 million, they were showing a $25 million income gain. That's how bad the accounting was. And then suddenly the accounting changed, and 100% of that volatility went on the income statement. And what did companies do? They shut down their pension plans. They didn't hedge them and fix them. They just shut them down. We're not doing this anymore. I was at a conference where the retired CFO from GM was speaking, and he was cursing the new accounting rules. He thought they were stupid. He hated them. GM in one quarter had to write off $16 billion because of this. The PE of the S&P 500 shifted really dramatically because GE had one massive write-off. Doesn't sound like a big number now, but back then it was a huge number. There was a lot of people who hated the change in accounting. USAA, we shut down our pension plan. It made me really upset me because I wanted to keep it. I'm going to talk about why I wanted to keep it. I tried to convince the CEO that we had it hedged, that the volatility was not there. They still have a pension plan, but only for people who earned it through that year. And they stopped giving new. And I really just like that. I'll tell you why. The other reason was stocks did really great in 1980s. People were making all this money. Stocks did really well in the 1980s. How did they do in the 1970s? Horrible. It's a horrible year. How did they do in the 2000s? Horrible. We had the dot-com crash, then we had the 2008 crisis. But from 1980 through 1990s, stocks were up. These pension plans were making all this wonderful income. It wasn't really income, but making all this income. So you had those two things going on, the accounting and then a strong stock market. And you'll hear this a lot of times is that, well, it's worked so well, so it must have been right. Is that a good argument in finance? I put 100% of my money in Apple and I'm making a fortune, so I should probably keep 100%. Would you recommend someone put 100% of their money in one stock? Would that be a good investment if it's worked well in the past? Any of y'all have 100% of your money in NVIDIA? If you do that, 100%, you would have lost a lot of money a couple of Mondays ago, but it's come back. Well, someone wins the lottery. Is that proof you should buy lottery tickets? Someone wins money in Vegas. Is that proof you should go to Vegas? So just because something worked is not a good argument. That may be a good strategy. Maybe you should do it, but just because it worked is not. We'll talk about that when we talk about Annie Duke and resulting and how we use resulting to make really bad decisions. That we grade decisions based on the outcomes, not based on the quality of the decisions. But that's the argument I hear a lot. You might hear it as stocks for the long term. Stocks always outperform bonds in the long term. Oh man, we're almost out of time and I have like 6 more hours to go. All right. Let me talk about where we are today and the death of pension plans. But I'm going to argue if pension plans had done what life insurance companies have been doing, they'd all be open and be working today and people be in great shape. I'll tell the story of a good friend of mine that USA's pension plan was the only thing that saved her for retirement. She could have never retired without it. I think we need them. It sounds paternalistic, but we'll talk about that. But yeah, the change in the accounting and probably those two horrible stock markets have been the death of pension plans, except for on the public side. So California, Illinois, big state plans are still around. And then I'll talk about how to apply this. So this is a killer essay on the first exam. Hopefully you've been taking notes and have it all ready to go because it is a killer essay, but we'll talk a bit more. Okay, I'll stop it there. I want to finish up. So on the exam, you have one massive essay question, which is almost a short paper. You're going to turn it in at 7:30 by 7:30 the night of the exam in Word. In your own words, you can't copy and paste. You have my blog, you have this PowerPoint, you have the Arnott article. I would recommend you just read my rewritten one. And then you have a rubric. We'll go through the rubric. When we go through the rubric, I highly recommend you take copious notes because first of all, you're wasting your time because you got to do it anyway. Secondly, if you don't, then you come back before the exam. This is all new stuff like you've never seen before, which means you got to go all the lectures. You got to reread everything. You've got like 20 hours of work to do the night before the exam. Third is just my attitude, if I were you, is I'd be desperate to learn every single thing taught in all my classes because you're walking into an incredibly competitive. I know a lot of students, the focus is on what do I have to do today? And that shouldn't be your focus. Your focus is what can I learn today and learn permanently, put in my permanent memory. You should be desperate for knowledge. I had a great student that I talked to a couple of days ago, and now he's been fired by Elon Musk. So he's now looking for a new job. And he's a really good student. So I've already sent him a letter of recommendation, sent him some job opportunities. Really sharp student, but in the middle of, he's doing a job, really, really good job. Sharp kid. Y'all are all kids, but to me, but he's going to do fine. But it's, you get married, buy a house, do your job really, really well, you're moving up, and then suddenly it changes. What's his one protection? Smart, discipline, has learned stuff that he's retained. So I would be desperate to learn this stuff. That's just me. I wouldn't waste a 75-minute class surfing the net. And is surfing the net still used?
Yeah.
Okay. My boss used to say it right when the internet came out, like he was the coolest guy in the whole company, and he didn't surf the net. He just talked about surfing the net. So, all right. So don't waste this time. This is a really good time to get a lot of this essay at least outlined tonight. So we'll talk about it. This is a tough question, which is good. The harder something else is, the better it is for you. One of my problems with finance, most classes, we give students the hard stuff and ask you to calculate the easy stuff. And then you get a job and guess what they do? They ask you to come up with the hard stuff and do the easy stuff. Your boss is not going to walk up to you and say, here's the beta, here's the risk-free rate, here's the growth rate, here's the dividend. Can you figure out how much the stock is worth? They don't do that. You got to come up with all of that. So this is the hard stuff because this is where finance matters. The easy stuff doesn't matter because you can do that in second or third grade. The math is pretty simple. So learn the hard stuff. You should be excited when you have a class where you say, man, I'm not getting this. That should excite you. It's like, I should really, really learn this, get into it, right? Leah, like earlier, well, I don't get, it's tough stuff. So that's good. If it wasn't tough stuff, how much are they going to pay you to do easy stuff? Not a whole lot, right? So you got to do tough stuff, learn tough stuff. If you really learn what we're talking about here, you could have walked into Silicon Bank and saved the entire bank by just asking some really simple questions. What's the duration of your net worth? What are you talking about? Oh, we learned that in my class. You want me to set up a conference call with my professor? He can probably give you some good contacts. You could save the entire company. We'd be pretty nice your first month out on the new job. All right, so let's talk about this. What's happened with pension plans? Why have they gone out, especially on the private side? Most firms have ended their pension plans. because of the accounting rules. Remember, doing the exact same thing life insurance companies are doing, and life insurance companies are still doing what they're doing. They didn't end it all, but pension plans have ended it because the accounting rules have changed. And we had two major bear stock markets. And remember, they're loading up on stocks. The accounting rules changed, and now that all comes out pretty dramatically. And you can see I don't know what date I went through here. I could have probably found a more recent one. This is old. There's more recent ones you can find. Defined contribution plans, which is what most of you are going to have. Whoever's on Zoom, please mute. It's my mic. I don't know. Yeah, I don't know where it's coming from. So most of you can get DC plans, defined contribution plans. That's where you contribute, your company matches, it's your money. It's not even on the company's balance sheet anywhere. It's completely off the books. It's not their money. It doesn't affect their accounting at all other than their contribution. Their contribution is a compensation expense, just like any other salary expense. It's easy for the company. They have some costs to do with it. And this is where companies rip off their employees, and DC plans doing bundled. So if your employer does a bundle plan, you should fight it pretty hard because they're ripping you off when they do that. So companies have found ways to use the 401k plan as a revenue center, but it is the most popular one now, mainly because the accounting is really simple. It's not their money. It's just the cost of paying employees. It goes off the books. Really, really simple. Defined benefit plans have fallen. They used to be the bigger of the two. Part of this was, if you read the history of 401k, it's been in the tax code for quite some time, but some guy in the early 80s read the fine print in the tax code and said, hey, you know what, we could do this. We could do this 401k thing and save a lot of money for our employees. And so that got set up. And then it's taken off, and it's really taken off since the accounting rules have changed. Public pension plans are still being offered. They're huge liabilities. They have high allocation to stocks, just like the private plans did, just believing that stocks are the place to be long-term. The accounting rules on the public side have not changed. They're not quite as volatile. You're hearing some of these debates. If you talk about the post office will say, Congress is saying the post office is losing money. We got to bail them out. The post office says, before our pension plan, we're making money. After our pension plan, we're losing money. So they're blaming it all on their pension plan because it's such a huge, huge benefit. It's a nice benefit. If you know any retired postal workers, I mean, it's a nice little pension plan. My dad was on a state pension plan, and yeah, it paid $7,000 a month. That's kind of nice. They could live very comfortably on that. So the private side hasn't changed. I mean, the public side hasn't changed the rules, and they've kept doing this. Several states, Illinois is a good example, just in California, even just near insolvency because of their pension plans. So grossly underfunded. I don't know if y'all have studied Japan and its pension plans. Japan has a serious problem with these type of plans, making promises. You can't go to Pension Tracker anymore. They took it down. But they say California was underfunded by almost $1 trillion. That's about $75,000 for each California household. You're not going to suddenly tax each household $75,000 to get out of this. So what do? Load up on stocks. Have y'all heard hope's not a strategy? Their hope is a strategy. Let's load up on stocks. Stock market rescues us. The stock market crashes, we were done for anyway, so now we're just really done for. But remember when California was fretting about a $50 billion deficit? At a time when it had a $1 trillion deficit in their pension plans. So these are massive, massive. I like pension plans. I know it sounds really paternalistic. Mainly because, first of all, most people with the 401k really don't know what they're doing. The people that are training them have horrible incentives. There's a really, really good Frontline documentary on 401k plans. And it's really embarrassing if you work in this industry to watch our industry on that documentary because we're really embarrassed. This JP Morgan employee, her plan is ripping people off, really overcharging with fees. When they pointed out, she goes, oh, I wasn't aware of that. Like, how could you not, you know exactly what you're doing. It was really embarrassing. why she went on TV. I don't know what happened to her at JP Morgan the next day, but it was incredibly embarrassing. Our industry loves other people's money, and we like making money, not for them, but for us. So it's the incentives are terrible in this industry, and this 401k has brought a lot of money into this industry, huh?
Going back to the state pension plan, why are they so underfunded now if they were, putting in money over time? Did they just lose a bunch in stocks and that way?
It's not just that they were not putting enough money in. And the funding rules are a little tricky, but I think the two stock crashes in the 2000s certainly hit it. Falling interest rates has been a big deal. Interest rates falling for all those years that caused a liability to resume. So it's kind of, the perfect storm. But when we say a perfect storm, stock markets crashes and interest rates fall, there's actually a correlation there. So it's a perfect storm that you would expect, right? So yeah, but a lot of it's just politicians like to promise more, but they don't like to tax more. So we had that problem with the Social Security in the 70s. Congress kept beefing up Social Security because senior citizens like to vote, but they weren't increasing the tax. And then Reagan and I forget, Tip O'Neill, so the head of the House, the Democrat and Republican, how much do they, have y'all probably don't know the history. It's pretty amazing. I didn't mean to do that, sorry. I can't do Zoom and think at the same time. So. I mean, it was massive. You talk about one of the largest tax increases, right? Talk about Reagan cutting taxes, but he increased the payroll tax. I don't know if it will show it in here, but is somewhere in here it will show it, but it was massive. Social Security, Medicare tax rates went up quite dramatically. I noticed it because I was self-employed. And the first time I did taxes, I had not been withdrawing from Social Security. And when I filled out my tax, my dad's like, "You owe a few $100s." Like, what? I'm a poor college student. I only make like $15,000. I was really poor. It's like, how can I owe tax? But I wasn't paying the Social Security piece, and that was a massive tax. So yeah, that's how they solved Social Security. But during the 70s, the problem was Congress just kept beefing it up without adding more tax, and it just got out of whack.
So would those pension plans, like state and local pension plans, would they still be in as much debt if they had, if they were adequately hedged? Or is it just like a legislative thing where no matter if they were adequately hedged or not, they would have still gone under because
So you got the two pieces. So if they'd managed it like a life insurance company, first of all, I would not have made the bigger promises because the actuaries would told them you can't afford that. I saw that at USA all the time. The marketing people, hey, let's increase our rates, The actuaries like, we can't afford it. So, well, let's increase the rates here. We're selling this. Okay, well, you better cut your rates over here. And there was that really good tension. I sat in a lot of those meetings and it was interesting. And it was a battle. The marketing people would win sometimes, but the actuaries, like, in the end, we always win. Because the end, the numbers have to balance. And they did. They were really good. It was a great tension. It was funny because they knew who they were. A good friend of mine, Larkin, she was the CFO. And she had these facial expressions like, you know exactly what she was thinking. And when someone said something stupid, you just had to look at her and say, yeah, that was. So she was really pretty powerful because she understood both sides. And she was like, they were really fortunate to have her. But that was the tension. And then the funding comes from the customers. But yeah, if you had that kind of tension with those kind of committees where their responsibility was to the entity itself and to the employees to make sure everything balanced, I don't think we would have any of these problems today. That means people on Social Security would not be getting as much today because they wouldn't have increased it so much, or they would increase the taxes. But you want to pay people more, but you don't want to increase taxes. In life insurance, you've got that. You want to pay your customers more, but you can't go insolvent. And those two are always balanced. So I like pension plans because I think most Americans are ill-equipped to plan for their retirement. So a good friend of mine was this picture. She was the cousin of a really good friend of mine. She worked on the auto and home on the homeowner side of USA. So she helped me with my insurance. I actually just invested her 401k plan in 2008. She had some losses, but it set her up for a really good 09. But she was like, "What do I do with my 401k? I want to retire. I want to retire." Well, she had been at USA for 30 something years. Her 401k plan should have been $400,000. It was $40,000 because she took so much money out of it. We were shocked when the committee authorized borrowing against your 401k plan. They thought, oh, maybe 5–10% of the employees would borrow. No, it was a massive number of employees were borrowing from their 401k. Employees raid those plans just dramatically, especially the poorer employees. She was taking money out because she had a son who had some special issues. She wanted to remodel her house, she wanted to buy a new car. Every time, I'm just going to do it this once. And the second time, I'm just going to do this once. The 8th time, just this once. The 20th time, I'm just going to take it out this once. Is she going to retire on $40,000? No, but she had a USA pension plan worth several $100,000. Guess what was her entire retirement? That pension plan. That's what she had. She had between that and her Social Security, she could just about retire. I told her, yeah, you can just bear it. If you want to retire early because she really wanted to get out of the job, she didn't enjoy it. So it's okay, just be careful. And then the next time I met with her, she bought a new house, remodeled it, and bought a new car. So it's like, yeah, that wasn't in our plans. Yeah, I didn't want to really see you again. But she's still, where would she have been without that pension plan? Do you think she would have had 400,000 in her 401k? No, she would have rated that. I think she's pretty typical of a lot of, I don't know, do y'all know what your parents are doing? Do you know what my mom's retirement plan is? I'm my mom's retirement plan. I mean, do you know what you may be your parents' retirement plan? Nicole.
So, whenever you're doing pension plans, like separate from like their 401ks a little bit, because I have a friend, he'll borrow from his 401k.
Yeah.
But like the interest gets paid back to him
Right,
essentially.
but that's what a lot of employees thought is when you pay the interest on that loan, it goes back into your account. And they say it didn't cost me anything. But if you take 50,000 out of your 401k and the stock market goes up 10%, and then you pay it back, how much did that cost you? You lost the opportunity cost of that investment.
Yeah.
Now, if you take money out and borrow it and the market falls 50%, then you're lucky. But what most people don't know, they take 50,000 out, the market's up 10%. Say, hey, that only cost me 6%, I paid myself. Well, no, you lost $5,000 that you could have had. So there's an opportunity cost that a lot of employees completely miss. They're like, wow, this is like free money. No, you're investing because you want to make a return and you now are not invested. So yeah, it was painful for a lot of the employees, but they took so much out that there really wasn't much left. So I think it's needed. That's somewhat the argument for Social Security as well. Social Security doesn't pay as well as other plans, especially for people in the kind of the $50,000 to $70,000 range. So I think it provides a more secure retirement. I'm not saying it has to be 100%, but I think it's pretty nice. If you know people in the military, it's pretty sweet, isn't it? Retire at 40 something, you've got a pension the rest of your life. Is kind of nice. And you work part-time. It's like, y'all know some of these people, right? It's like, well, how'd you get that deal? Retire at 40. State employees like my dad is just like, it's really nice income. It's secure. And the other thing is they don't really notice it. You don't say, hey, my company's putting aside 5–6% of my income into a pension plan. I wish I'd have that money. They don't think about it. They notice it with the 401k, right? Because it comes out of their pay. But the pension is compensation. They don't really notice they're losing it. So it's one of those things that it just helps them. I'm not normally paternalistic, but I've just seen this been such a big disaster for so many employees. So everybody's moving the 401k plans. My guess is almost all of y'all are going to have a 401k and no pension whatsoever. What does the 401k plan do? It shifts all that risk to the employee. They got to make all of these decisions now. They got to be good investors, and most of them are not good at that. In fact, at USA, every year they have this massive bonus. Most employees turn off their 401k for the bonus. USA matches 8%. They get a $10,000 bonus. USA is going to give them 8% of that for free, but they turn it off for the bonus. Why? Who knows? It doesn't make, there's no economic sense that that would be, but they do. And we got most people in their 50s and 60s are not prepared for retirement. I was going to retire from USA. I was going to retire at the age of 40. I was ready to go. And then I talked to my parents about the retirement plan, and I worked 6 more years. to save for their retirement plan because it's like, okay, they're not going to make it. So I had to get 6 years for their retirement. They don't have a pension plan other than Social Security. Their 401k plan balances are really inadequate. Again, my mom, her assisted living, I think I told you this, right? Her assisted living's $6,500, $7,000 a month. Her Social Security is $1,800 a month. It doesn't balance. She sold a house in Austin. That's helped a lot. So that gives her some income, but it's tough unless your son's Tiger Woods, you're kind of out of luck. So what's going to happen? They're probably going to have to work. Most people are going to probably have to work longer, or die earlier, whichever is going to happen. If they work longer, they probably are going to die earlier because that's going to be a wear and tear on the body. So it's a pretty tough. So I'm not trying to scare you to death, but you should have the conversation with your parents at some point. Do y'all know anything about your parents' retirement? They in really good shape? Some of you like they're really wealthy, so they're your retirement, maybe. I don't know. Yeah. So I like corporate pension plans, especially given that the only reason we shut them down was because I think they were poorly managed. If they've been managed in a really prudent, actuarially sound way, I think they'd still be around. If they've been managed like life insurance companies, I think we'd still be where we would have, we'd be where life insurance companies are. So people are going to just keep working and working and working. I was working with one family. They had 2 special needs kids. The dad had health issues. He needed to retire. The mom was exhausted. And I said, there was no solution. It was really depressing to me. It's like, the only solution is for you to keep working. And they're like, we can't keep working, but we got to support these kids are going to be living with us the rest of our lives. It's like, I didn't know, there's nothing I could say. I mean, maybe that's when you say buy lottery tickets, because there was really no solution I could come up with, except for they're going to have to keep working. And I think that's really what they decided to do. I had one couple come to me, they had so much money, they need help to know what to do with it. That was kind of fun. I said, spend it now, because the goal is not to die with as much money as possible. Spend it now, enjoy it, give it to your kids, give it to your charities. But most people, it's the exact opposite. It's like, there's no way I can make it work. And they're asking me to help them. It's like, there's nothing you can do. You don't have any money saved up. You have nothing but debt. Your health is diminishing. You've got kids you're gonna be living with the rest of your life depending on you. Yeah, that's a story of a lot of Americans, and I think we've kind of done it to them. So how do you apply this to you as an individual? This isn't part of the exam essay, but just to show you. So if corporations and governments heads off at interest rate, what should you do? Am I recommending you put most of your money in bonds? And the answer to that, we already somewhat talked about it, is yes, except for you have an asset that already looks like a bond. You already have most of your assets in bonds. It's called human capital and human capital optionality. Those that took my life insurance class last semester, who was that? Some of y'all in here did, right? You got to write a whole paper on this, right? You remember, Scarlett? You remember that paper? Huh? Oh, good. Yeah, it's a good paper. You can actually, there's actually college classes. I was watching one, I think at MIT on human capital. I was watching on my phone and he had these formulas over the entire chalkboard. It's like, I can't do that when I'm riding a bike, but it's pretty complex stuff. Human capital is the present value of your future income. For most people, that looks like a bond. Your income's not going to go up 50% and drop 30%. It's going to be fairly stable. It's going to go with inflation. So your human capital is a huge asset. It's bond-like, and it's more than adequate to allow you to put almost 100% of your money, if not 100%, into the stock market for most young people. You have something pension plans don't have. They don't have this human capital component. And then human capital optionality is the fact that you can go back to school, you can change careers. There's things you can do to enhance that. That gives you some protection, adjustments that you can make that really corporations can't do that same thing. So human capital is the key for why young people put so much in the stock market. If I were you, I'd put 100% of our money in the stock market. If I was your age. I know if you go to Vanguard, they have, for your age, 90% stocks, 10% bonds. I think that's ridiculous. You should just be 100% stocks. Now, why would I say that? Well, first of all, if you have 90% of your money in stocks and 10% in bonds, that's your dollar allocation. What is your risk allocation? Your risk allocation is like 97% stocks and 3% bonds, because what's riskier? Stocks. Stocks are going to dominate. So right there, you might as well just go 100% stocks. The second thing is, and I say this all the time, I think most people agree with me. In 2008, I did not hear one young person say, boy, I'm glad I had 10% in bonds. I could have lost 35%, but only lost 33%. I'm so glad. Do you think anyone felt like that? Are you happy you lost 33% instead of 35%? What do you notice? You notice when the market's going up and you got that 10% there making 6% and everything else is making 30, but you don't on the downside. And Farsad talked about it somewhat last night with prospect theory. When you lose 33%, 35%, 37%, it all feels the same. You just lost a lot of money. You're pretty depressed and you're not thinking about, and that's where standard deviation is kind of the issue is. The theoretically statistical side is our brains can make these distinctions between 33, 35, 37. We really can't. We just lost a lot of money. So you might as well just dump it all in the stock market when you're young. At some point, as your human capital shrinks, you're going to have to replace it with bond allocations as you go through time. So yeah, at some point, you're going to have to start thinking about that interest rate risk that you have. But when you're young, it's really not that big of a deal. You just stick all your money in the stocks. In fact, if I were your age, I would do 90% in the stock market, and I'd take 10% and just start betting on certain stocks like a battery producer or some biotech firm or something, and just let it roll. Hope I happen to find the next Microsoft and just roll it like that. I think that'd be a lot more interesting than putting 10% in boring bonds. Plus, if you put your money in bonds, from this risk standpoint, you're probably not going to buy 30-year bonds anyway. You're going to do short-term bonds. They're not going to make you much money, and they're not going to provide you that much risk protection. That's just my opinion, but you have the same equation. Your biggest liability is your retirement, and you want to hedge that interest rate risk, but you effectively have, by just the fact that you're going to have a salary that's pretty predictable the rest of your life, that's going to grow with inflation. So questions on that? You could actually build your balance sheet and put human capital as an asset and your retirement as a liability, and you could run stochastic models on that and figure out what's in your best interest. You could really do that. And for you as a college student, you probably have that much more than, say, your parents that have houses and cars and other assets, portfolios on their asset side. But you could build a balance sheet and run balance sheet immunization on that. All right, there's human capital. Human capital optionality is your ability to change careers. This is really critical right now because the world's changing so dramatically with AI and machine learning and robotics. So if I were you, I would definitely be learning language, a computer language, probably Python or R or something. Use it every single day. So if your boss in your first job doesn't use Python, beg them that you can use it. So I have students who want to learn Python, but if you don't use it every day, it's somewhat of a waste of time. You got to be using it every day. I learned Excel at USA because we use it every single day. I mean, we're talking 6-7 hours a day. We're sitting there on Excel just constantly. You're going to learn it. Same thing with you. Most of my alums are really heavy into using some coding language pretty regularly. They still use Excel, but but you have to have something that's going to allow you to switch to another industry or another job pretty quickly. I shouldn't say this here, but if I were a finance major, I probably would not get an MS in finance as a graduate school because you're studying the same thing again. I'll probably go econometrics or do something else that's pretty radically decision science, management science, just because you need that variety bit to go somewhere else. My favorite story is Chuck Yeager. Have you ever heard of him? He was this test pilot. I think he broke the sound barrier or something, but why was he so good? And he says, people say he was really good because he was a test pilot, but he was also a mechanic. So he understood how to fly a plane, but he also knew what the gauge was telling him when the light went off, unlike other test pilots. So I recommend, I did this in my career, not as any plan. I was just scared to death because when I was where you are, I was scared of my own shadow. I just desperately learned every single thing I could in the company. Every time someone came to my desk with a number, I was like, where'd this number come from? How'd you do it? I would go back to their desk, can you show me how to do this? No one ever said no. You got to be like Chuck Yeager. You got to figure out the motor, the guts of that entity. How does it operate? What is marketing doing? What are the economist people doing? I made really good friendships with the PhDs in mathematics at USAA. They weren't the most social people in the world, which made it really easy to go get to know them. And they would let me sit there and just listen to them all day and learn. So that's human capital optionality. You give yourselves those skills so you can understand the whole business. Our most successful alums, I have one who's working for AES. Yeah, he knows finance, but he also understands wind turbines, solar energy. He understands the engineering side of this. If I worked at Valero, I'd be at the engineers, I'd be going to refineries, I'd be at the trade desk. So that's the optionality. Some skills are more transferable than others. Obviously, math and stats are extremely important. I should have put coding in there, language. Probably AI is pretty important. As we age, that optionality declines because we become dinosaurs. So you have to find some way not to become a dinosaur. So I'll leave out that last part, but those are the important things. I'm going to leave. Well, here's the formula. Scarlett could explain this to us, but what they're saying is over your lifetime, you're trying to maximize your utility, your alive utility and your dead utility. Your live utility is 1 minus your probability of dying. It's your wealth and your human capital. You're trying to maximize that. Your dead is your probability of dying. It's your wealth, but it's not your human capital. It's your life insurance. So that's the importance of life insurance. What does life insurance do? It has a -1 correlation to human capital. So you get this perfect hedge, but that relies on your bequest motive. You don't care if you leave anything to your heirs, then you don't need the life insurance because you don't really care. You're just going to leave your wealth. But in one formula, they have it all set up. You're trying to maximize you alive and you dead based on your probability of death, looking at your wealth, your human capital, and your life insurance and maximizing all that together. So that's another way of looking at that equation. There's more to it than you dead. There's also you sick, you injured. You know, there's other U's that you have to worry about, but from a basic standpoint, that's what you're after. All right, so let's look at the rubric for this. And this is when you better take, oh man, I'll be taking notes. You should probably leave tonight with 47 pages of notes, handwritten notes or typed notes. So here's the question on the exam. So let's first get the inputs. The article by Robert Arnott. So Monica pointed out this to me, and I should get better at this. So y'all make sure you know what's on Canvas. So you got the article by Arnott. Which one should you read? I do the rewritten one. What I did there is, first of all, I took that really complicated chart he did with all the cash flows, and I just did 2 cash flows. Y'all remember that chart I did? The second thing was he kept using different terms for the same thing. And I just took all those terms, and so if he used 3 terms for one thing, I put all 3 of them every single time. So there wouldn't be that confusion. You've got the PowerPoint that I've just been showing you. And in the PowerPoint, at the very, very beginning of it, it gives you the link to my blog, which essentially is the PowerPoint, but written. So you got those 3 inputs, all right? The article, the PowerPoint, and the blog. So if you look at the question, summarize Arnott, blog. The blog is really the key to it. Discuss what finance theory would say about whether a firm borrowing at 4% or offering a pension plan. Remember, I'm saying that's essentially the same thing. You can borrow money in the debt markets, or you can just tell your employees, I'll pay you later. So instead of paying you $20,000 or $50,000 a year, I'll pay you $45,000 a year, and I can put $5,000 away for when you retire. That's borrowing money. It's the same thing. And investing in the stock market to make 8%. And here's the key: would this increase or decrease the value of the firm? All right, so that's the question. Here's the blog again. I'll put this exam review out there. So First of all, Arnott says there's 4 risks. Well, he says there's 3. I say there's 4. Anybody remember those 4? Get these down in your notes. Some students get so confused because they don't know. So there should be a single person here that doesn't have paper or computer they're writing on. Some students stare at me with a blank desk, just assuming I'll never say anything intelligent. It's possible, but right now I'm talking about what's going to be on the exam, so you probably want to write it down. Anybody remember those 4 risks? Career and peer risk, kind of put those together. So he talks about peer risk. The second one. I heard it real softly, but say it. Asset risk. What was the third one?
Selection.
Well, that's part of the peer risk, selection risk of what you're going to invest in. What's ALM risk, which is what we're talking about with balancing immunization, and then the career risk. He doesn't mention in his article career risk. I'll put in career risk because what does our industry manage? Our industry manages career risk. We don't manage our customers' risk, we manage career risk. Remember that hedge fund manager, he's so excited to lose 1/4 of my money. Why? Because all he cared about was peer risk. He beat his competition. All right. So peer risk, that's the risk that you underperform the competition. That's the most important one for career risk, which is the most important risk for the industry, which is where we spend 98% of our time, 99% of our time. So peer risk and career risk, you won't find career risk in Arnott's article, but it's implied. Asset risk is just the risk that your assets fall in value. 2008, the stock market crashes, you lose value. ALM risk says, well, assets can fall or rise in value, but the important thing is how they rise and fall in value versus the liabilities. If they fall 10%, but the liabilities also fall, you might be all right. If they rise 10%, but the liabilities rise a lot more, you may be in trouble. All right, so ALM brings in the liability. All right, so those are the 4 risks. Any questions on that?
You said that you added career risk?
Yeah, if you read Arnott's article, he only mentions 3 risks: peer risk, asset risk, and ALM risk. I add a career risk just from my experience, because I know that's what the industry is focused in on. And that's kind of implied for peer risk, right? Your customer doesn't leave you because you lost 10%. It leaves you because you made 5% when the competitor was making 10%. It's a relative. Y'all got the first one? What about the ALM risks? There are 4 risks to ALM risks. This is not in Arnott's article. This is in my blog. I didn't remember the 4 risks of ALM. So some students get these mixed up. It's 4 and 4. All right. So the first 4 is peer risk, is related to career risk, asset risk. Then you have ALM risk. Let's take ALM risk and talk about the 4 risks that come from the liability. All right. Y'all see how that works? So 4 risks that our industry manages. That last one, ALM risks, brings in the liability. What are the risks and the liability? Y'all got that? Can anybody repeat that? What I just said? Is that logical?
So it's just a subcategory of the ALM.
Right. So let me type it because we'll make sure you are clear. So our industry, what is our industry? The investment industry manages 4 risks. Anybody know what those are by any chance?
Peer
Risk,
career
asset risk, ALM risk. Okay. Where do they spend most of their time? Career and peer risk. Where do they spend almost no time whatsoever? Which is the biggest risk? ALM. What's the smallest risk? Peer risk. So we got it backwards. All right. The way I like to explain it, this is a crazy analogy, but I have crazy analogies. I want to get this on a t-shirt one of these days. But here it goes. I'm going to think this maybe, I don't want to upset anybody, but if someone's holding a gun to your head, that's not the time to be worried about your cholesterol level. That's the way I explain it. Someone has a gun to your head, go, man, my cholesterol level is really high this last week. Maybe I should cut back on some of these fatty foods I've been eating. What should you do? Maybe address the gun first. You may not know what that person is going to do. You may not know exactly what to do, but that's the most immediate risk. It's the biggest risk. Does that mean cholesterol is not important? It's still important, but there's a time to handle that later.
So if we're to be logical, right, we would weigh those risks based on the incentives that plan, like the incentives are structured to
Very good point.
that good risk mode. So how would you restructure the incentives of the industry to make ALM risk adequately valued in terms of?
Yeah, it's tough because it's been doing this for so long. I don't know if it's possible other than you guys be corrupting y'all enough that y'all start asking these questions, right? This is how I did it at USAA. So I'll give you, we're kind of get a little off track here, but at USAA, so before we did this at USAA, we spent an hour and a half talking about peer risk. Manager A is underperforming, blah, 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 blah. So we fire them. No, we're gonna give them more time. Manager B is doing really well, but they were horrible last year. They'll probably be horrible next year. Manager C, we went through that. Guess how many managers were beating the benchmarks? About 50% of them. Guess how many were underperforming? About 50%. And it was uncorrelated. One year they do well, one they do poorly. I remember telling my future boss, the head of the investment company, I was presenting, I go, hey, Putnam, boy, they've been killing it. They've had a great year here. I said, I don't know if it's luck or skill, but they're doing great. And the head of the investment company says, you don't have numbers like that with that skill. Guess how Putnam did the next year? Horrible. So yeah, so that's it. So at USAA, we completely eliminated all that. We had no more peer risk. We went indexed on the stock side. So at USAA, this is what we did. Asset return, 10%. Liability return, 9%. Spread or alpha, however you want to say it, 1%. It took me 3 minutes to present the pension plan. This is where our assets sit, this is where our liabilities sit. Any questions? Pretty simple, right? We just cut an hour and a half presentation, or hour-long presentation down to a few minutes. And it's pretty sweet. Like, I love my name Sweet. So we made it pretty sweet. So that would be a solution if I were compensated based on that versus compensated. I was compensated based on this, which means this became what? When I'm compensated. So it's a perfect, Arnold's just making a perfect point. We're compensated based on number one. So what does that make two tied to? What is two going to be tied to? Your compensation. We're paid based on number one. So number two becomes tied to number one. What if we were compensated? How are life actuaries compensated? ALM risk. That's how they're paid. So guess what their focus is in? ALM. So yeah, good point. You might want to put the word incentive into your answer because I think that's a great point to make. All right, so the L of ALM has its own risks. What is the L? The liability. What are the risks of the liability? So don't get the 2-4 lists mixed up. Everybody real clear? We have risks that the industry's managing, but we do ALM, you bring in liability, it's a special risk. Anybody remember these 4 risks? Longevity risk. The risk that the people in the pension plan live much longer than expected. And adverse selection risk. What is that one? Healthy people do what? They take the pension. Unhealthy people do what? Take the lump sum. Yep. And people know their health pretty well, and they're going to make those decisions. They may not make it perfectly, but they'll make those decisions. What's the third one? The most, well, depends on what order you do them. Interest rate. It's probably the largest, but it's the one we can manage the most easily. It's the easiest one to manage, but it probably is the largest. And then the fourth one, inflation risk. Most of these pension plans do have a cost of living adjustment. That's the one difference here between pension plans and life insurance companies. Life insurance companies do not have products generally that adjust for inflation, which gives the life insurance companies a little bit of an advantage over pension plans. All right. Are y'all good with the first 2 things on the rubric? Is good, clear, all right. Hopefully y'all are liking that I'm spending this kind of time. I really do want good essays. I really actually just want you to understand this stuff. I mean, to Arnos's point, I do want to corrupt y'all so y'all change this industry because it really is a poorly incentivized industry. So we just talked about this. What is the focus of the industry? They're focused on peer risk, which means peer risk is their career risk. You can read that in Arnold's article. On this next one, the size or the ALM risk, there's a few things here that talk about it. One is its relative size. There's a table in the article that if you just bring that into your paper, even though it's really dated and old, it's still essentially current that you can bring in, and that gets you a lot of that. So if you look at the article, the bottom of like the second page, he talks about the different risk. Peer risk is the smallest, ALM risk is the largest. I really have trouble understanding what he means by peer risk. I do know the majority of pension plans underperform benchmarks. They would save money if they just bought index. That difference between what they return and what they could have gotten if they just bought the index, whether it's positive or negative, the impact to earnings per share is like $1.28. Asset risk, which is a strange one as well, because asset risk by itself, when you ignore liability, doesn't make a lot of sense to me, but it's about $2.61. When you bring the assets and liabilities together, that's twice as big as the second biggest one and almost 4 times larger than the smallest one. And our focus, our attention is exactly the opposite of that. Our focus is on the peer risk, not on the ALM risk. These firms had an average earnings per share of $2.24. So that $5.12 is quite material to their earnings. And remember, before they didn't care because of GAAP accounting spread all that out over 40 years. Now, all of a sudden, that volatility. So if you read his original article, is before the GAAP accounting changed. That's another reason to read my rewritten one, because the change in accounting took all this volatility and moved it to the income statement. And that's one of the reasons people shut down their pension plans. All right, so this table is pretty important. It's old, but it's probably not that radically different. Questions on that one? The size of the ALM versus what? The others. So you might make sure here by the others, I mean peer risk and asset risk. And make sure you know there's a table in the Arnott article for that. This next one is where you got some work to do. These next two you can handle together. I never spell asymmetry. Maybe Bill Gates can. These two you can answer together, and how would you do that? It's exactly what this table is showing you. This table right here. If you understand this table, you have both of those there. It shows you how the liabilities. The key here is the shorter term liabilities, the ones that you're paying immediately, they're the biggest part of the liability because of the discounting function. The liability is way out in the future. They're a small part of the liability. Why? Because the discounting brings them really small. They're like 10, 15%. But where does all the volatility of the liability come from? It comes from those longer term liabilities. And this table shows you that the long-term liabilities are 14% of the present value discounted cash flow. But when interest rates fall, they rise a lot more than the shorter term, because why? They have two things. The Now, Monica said you could ignore the second one, but you don't have to. So what are the two things? If anybody remembers DC cuts I from my other class.
Duration or convexity.
They have a lot of duration and a lot of positive convexity. What does that mean? When interest rates fall, they go up a bunch. When interest rates rise, they fall, but not as much. That's the positive convexity. That's horrible in liability. It's wonderful for asset. We love it for assets. Interest rates fall, our bonds go up a bunch. Interest rates rise, they fall, but not as much. That's wonderful. That's high duration and positive convexity. But for the liability, and that's the asymmetry of this, is the impact of rates rising versus falling rates, the liability goes up a lot more. Arnott talks about that in the article, and you can actually quote him if you want to answer the asymmetry part. So I'm not going to go through this again, but this table, if you can recreate this table in words and use numbers, maybe the best thing to do is don't use $500, use 1,000, so you can show me you know how to do the math. It's pretty simple math because it's just discounted cash flows. This is the understanding of it. In Arnott's article, if I can find the word asymmetry, there we go. So on page, I don't have page numbers, and I can't see the page number. So there's a page number here. I don't know what page it is, but this page number under the table, he says there's an asymmetry to it, and he explains it. If rates were to rise 150 basis points, the liability falls 34%. If interest rates fall 150 basis points, the liability rises 53%. That's that asymmetry. You wish it was the other way around because this is a liability. If it's an asset, that's wonderful. If it's a liability, in my investment class, it said we love positive convexity, but we're talking about investments. Assets here, we're talking about a liability. We don't like that. That asymmetry means you're really harmed when interest rates fall. If you want to say that's positive convexity and show off, that's fine. You don't have to say that. The asymmetry is, that's what the asymmetry is telling you, right? Those that took my investment class, that's the asymmetry, positive convexity. All right. Questions on that? We figure out what page it was. I don't know what this thing is here. It won't go away. Page 3 or 4 at the bottom, page 3. Just if you can figure out how to spell the word asymmetry, just look for the word asymmetry. You can find it. It's 1 S, 2 M's. All right. So we got the relative size. We have that issue of here. Short term is larger portion the liability, but long term dominate volatility the liability. If you understand that and can put it in words, you'll really understand the risk he's talking about here. Questions on that? That takes care of these two. Now, what Arnott says, he says you got these 3 risks: peer risk, asset risk, ALM risk. He says firms should make it a goal of balancing 2 out of 3. What he's saying is someone has a gun to your head, you got cholesterol, and your right knee's hurting. He said, hey, try to get 2 of those 3 taken. What would you do in that case? What would you recommend? Gun to your head, cholesterol's a little high, and your knee's hurting you. I would do 1 out of the 3, which is the gun. I might talk about the other ones later. So I disagree with him on this. Why is he saying this? He's a lot smarter than I am by a wide margin. He would probably agree with me. Why is he saying this? It gets back to what Arnos was saying. He understands the incentives of this industry. He's proposing something that is at least doable. I would say 2 out of 3 is good as long as what? One of them is what? The guy with the gun, the ALM, right? So as long as the guy with the gun is 1 of those 3, 2 of those 3, then I'd be fine with that. But that's what he recommends. I don't agree with that. He calls it balancing the 3 risks, but I want you to read his recommendation. To me, it's a political compromise, recognizing how this industry is paid, right? I do like his recommendation. So what is his recommendation? I showed y'all that last class. It's the paragraph that I rewrote. It starts here in the last paragraph on the last page, in the first column. Most plans are holding too little in bonds, right? They got 70% in stocks. At USA, we flip that. We're 75% bonds, 25% stocks. They have too little in bonds, and the bonds they're holding are far too short in duration. So remember what we need with these bonds? They need to have a lot of what? Two things. DC cuts I. They need a lot of duration. They need a lot of positive convexity. Why? Because the liability has what? A lot of duration, a lot of positive convexity. So they're holding too little in bonds, and the bonds they're holding are not the right kind of bonds. They don't have enough duration. They don't have enough positive convexity, right? If you want to paraphrase his sentence, you can. I think his is a little bit hard to read. I hate criticizing Arnott because he really is kind of the genius of our industry. First time I met him, I felt like he's kind of an arrogant guy, but he's not arrogant at all. He's actually really humble. He's just really quiet. He's a great speaker. Every conference he's spoken at, as soon as he finishes, everybody's running out and calling their broker to redo their entire portfolio because he's a pretty convincing guy. He's a really smart guy, really nice guy, quite brilliant. I recommend reading what he writes. So, all right. So, any questions on that? That's his recommendation. He says, "Hey, don't perfectly do balance sheet immunization, but at least address those long-term liabilities. They're only 10 to 15% of your liability. You don't have to go crazy. Just get enough bonds to get rid of that interest rate risk." So y'all see how that ties back to this? He's saying at least buy bonds to eliminate this risk. At least do that. It's not massive. 14% of your assets and really the long-term bonds are really not long-term bonds, probably swaps, because you need that duration convexity. At least manage that. Any uncertainty on that? Now remember, my chart looks a lot different than his. If you read his article, it gets a little more confusing. But this is the smallest part of the liability, but the most volatile. You can eliminate a big chunk of your risk by just hedging that part of the liability, the long-term cash flows. I see a few furrowed brows, but hopefully you're kind of getting it. What is my recommendation? Some students say, well, he thinks we should go 100% stocks because we're young, we have human capital. Is that part of this question? No. It's nothing to it. Some bring in my option strategy. We haven't talked yet. That's not it. What am I talking about here? Balance sheet immunization. You should buy assets to eliminate the risk of the liabilities. What other industry does what I'm recommending? Life insurance. I'm recommending you do exactly what the life insurance industry has been doing for decades and decades and decades, and has had very few insolvencies in that period of time. Whom did life insurance companies hire? They don't hire finance people either. They hire actuaries. Very different group of people. We may even have some actuaries in here. I may have told you all this, but my proudest day of my entire career was talking about this on the phone, and the guy asked, "Oh, are you an actuary?" And I was like, "No," but wow, it's like the best compliment I've ever got in my life. So yeah, actuaries think about risk. If you're in a firm that has actuaries, you should be sitting at their desk every day because they can teach finance people a whole lot. We're going to talk about Doug Hubbard later. He's going to say finance needs to learn from engineers, learn from actuaries, learn from the medical field. He thinks finance is just, we're not learning from other fields that understand risk a lot better than we do. All right, so, and this is part of what I just talked about here, the benchmark. I erased it. But what was the benchmark at USAA? What was my benchmark for my assets? It was, well, I mean, my benchmark. What was I trying to beat? My liability. My benchmark wasn't the S&P 500. It wasn't the Lehman Ag. My benchmark was, what did the liability return? If it returned 8%, what better my assets have done? You better give me 8%, right? So it changes the benchmark. The industry's benchmark our investment indices. It's the S&P 500, it's the Barclays Ag, it's EFA, it's those kind of things. It's benchmarks to what? What does it measure? What kind of risk does it measure? Measures pure risk. That's what the industry is focused on. Do y'all see pure risk in mine? Not even there. We did have active bond managers, but bond managers are pretty close to their benchmarks, so that wasn't that big of a deal. But all of our stocks were indexed, so we're buying an S&P 500 fund. There was no reason to show that to the committee. So that's what I mean by the benchmark. My benchmark is the liability. It's not the S&P 500. It's not those other things. It is the liability. It's the only thing I care about. Same thing with the life insurance company. That our assets earn more than we paid our liabilities. So we're in good shape. All right, and then you get to the blog. How do you increase the value of a firm? Increase free cash flow by doing what? Positive NPV projects or reduce WACC. Okay. What does a pension plan do to the WACC of a firm? Increases the beta, but not like normal debt. It really increases it. Why? Very, very high duration, very, very sensitive interest rates. Also has the COLA. So a pension liability is not like normal debt. It's like normal debt it's like debt on steroids. Very, very high systematic risk. Very sensitive interest rates, sensitive to inflation. A pension plan makes the firm's beta really shoot up. If you take that money that you didn't give to your employees, you invest it in the stock market, what is that going to do to the free cash flow of the firm? What's the net present value of investing in the stock market? Zero, does nothing. So you just done something that increases your WACC, it has a zero NPV. What have you just done to the value of your firm? You destroyed it. You would have been much better off giving those employees their salary and just been done with it. So here's your pay. We're not going to do a pension plan. All right. What if instead you hedge like I did? What's the net present value investing in the bond market? Zero. What's the impact on your WACC? Reduces it dramatically. Why? Because it takes away all of that risk of that liability. Essentially diffuses that debt issue. So the net present value of investing in markets is zero. So this isn't even my list, but it's up here. So I probably should say, maybe I need to change the rubric. So a pension plan plus stock investing, what does it do? Increases WACC, no impact on free cash flow, value falls, pension plan, balance sheet, immunization, WACC impact is diffused in WACC falls, no impact, free cash flow, value rises. If you really need that in your answer somewhere, I probably need to put that into the rubric. Really, really important. Why do I recommend you do balance sheet immunization? Has no impact on free cash flow because whether you buy stocks or bonds, you're going to get the same net present value because you're getting paid for your risk. You get a higher return with stocks, but you have higher risk. You get a lower return with bonds, but lower risk, net present value, free cash flow impact's the same. However, investing in balance sheet immunization, it reduces that WACC, value of the firm goes up. So I'm saying balance sheet immunization actually increases the value of the firm. Now, ideally, this question would come in an interview and you could go through that entire thing off the top of your head logically and clearly. That'd be ideal. That's really what you're after. You might try that once you write out your answers, see if you can do it talking off the top of your head without looking at it. Because if you have to look it up, you don't know it. But this, y'all can see why I love this stuff so much. It's really, really fascinating stuff. This was a huge project for us. I took a $3 billion pension plan that was 70-something% in stocks or 70% in stocks. And we took it to 25% stocks and 75% bonds. The only pension plan, major pension plan in the United States to do that. Pretty risky, pretty scary to do. Why? Risky in what standpoint? Pure risk. Risky from that standpoint, but it made a lot of sense. Fortunately, I had a CEO who said, be different. I love that. So it kind of worked with him. Questions on this? That's kind of gets back to the initial question. Is doing a pension plan and sticking in the stock market increasing the value of the firm or reducing the value of the firm? I'm arguing it's reducing the value of the firm. Doing a pension plan, but hedging it. Yeah, you got all this debt, but you're going to hedge it. You're going to diffuse that. You'll take the value, you'll take the impact of the pension plan that's harming your firm, and you take that impact out, and your value comes back to where it would have been. I would say if you're going to do a pension plan, invest in the stock market, I would say you're better off not having a pension plan, just do the 401k plan or give the money back to your employees. Because you're really destroying the value of the firm. And then why do I argue that? The very, very last thing, because that's what your job is. Your job is number one, the pension plan beneficiary. They get no benefit from the stock market allocation, even when the stock market takes off. They do get the detriment if the stock market falls, because that may mean the pension plan can't pay off its liabilities, but they get none of the upside. They get all of the downside. Does that sound like that's in the best interest of the plan participants? I cannot make an argument that that's in their best interest. So the obligation of the pension plan sponsor is to put the plan participant first, not the company, not anything else, plan participant first. Which means, according to the fiduciary responsibility, ALM risk is the only risk you should care about. You shouldn't care about any of those other risks. Massive question, isn't it? Y'all have it written now? Anybody ready to turn it in? All right, Arnis, you got it? Can y'all type that fast? Could you do it off the top of your head talking yet? And remember all the pieces? So yeah, I love this stuff. This is probably the biggest. I should find Ace at USAA working in this project and have him talk. It was a fun project. Now I did talk to a guy at Barclays. I could probably find his name out there. So there was these consultants. They wanted us to hire consultants. Everybody wants to consulting, make $200,000 to tell you what you're already going to do. His argument was stocks have long duration, so they hedge the liability risk. That was his argument. Why did he argue that? Because what's the value of a stock? It's dividend 0 times 1 plus growth divided by the risk-free rate plus beta, the market equity risk premium. Y'all remember this? If you haven't had this, Gordon Growth, dividend discount model with CAPM. And he said, look, right there, what happens when interest rates fall? Value goes up. Not only did he say that, but he said stocks have very long duration. Right? Because especially if you're doing like Google, they're not paying any cash now. All their cash is way out in the future. Very, very long duration. And I said, thank you very much, and never called them back again. Why is that? Well, 2008, risk-free rate fell dramatically. And how did stocks do? Did they shoot up in value in 2008? They were down 35%. Why is it? Well, because when interest rates are crashing, risk premiums are rising. Oh, I left out the last part, minus growth, sorry. This is rising and this is falling. This rising and this falling are more than offsetting the lower interest rate. Why? Because interest rates fall during a recession. Equity risk goes up in a recession, expected future growth comes down in a recession. Yeah, the stock market does not have reliable long duration. So And so he's essentially arguing, yes, 70% of stocks makes perfect sense. Stocks are a good hedge. Some people always say, well, stocks can be a good hedge for the inflation piece. That's a little bit stronger argument. Stocks do really well with expected inflation. They do pretty well with demand pull inflation. So if inflation's going up because the economy is really hot and people are buying stuff, stocks tend to do very well. Stocks hate cost pull inflation, which is like in the 70s when OPEC was raising oil prices. But inflation wasn't going up because the economy was strong. Inflation is going up because costs were rising. Stocks don't like that. But there is some truth to that. Stocks do help hedge with inflation, but it's not reliable year in and year out. So I don't like that argument either, but I never called him back. He's probably wondering why I never called him back, but I wasn't going to pay him a lot of money to say, hey, just stick a lot of money in the stock market, because that just didn't feel right to me. All right. I'm good. That's the essay on the first exam. On the second exam, there's several essays, but you get to pick and choose which one you want to do. So we're going to cover a lot more stuff. There's still tough essays, but you at least get to pick which one you like to do. This one, there's no choice. I too much love this essay to give you any choices. You got to answer this essay. I love it because almost the entirety of finance is in that question, all in one little question. So I love it. So no more questions are good. Everybody's gonna get 100 on this essay. Sebastian.
If you some handwritten or you type it out?
You're gonna type it and send it in Word. So 7:30 the not exam, you're gonna submit it on Canvas. Make sure you watch plagiarism. If you just copy and paste for an R-Not article, or you copy and paste put it in your own words. Make sure it's clearly in your own words. All right. All right. What I'm going to do for Tuesday is I'm going to put another balance sheet immunization problem out there, and we'll work it in class. If you want to work it in advance, but I want to make sure everybody's clear. What I really want you to do, I know you're working on paper one. We'll talk more about paper one here pretty soon. Let's focus in on exam one, get ready for the use math. The only thing else left on the exam, you got this essay, you have the balance sheet immunization question. The only thing left are some simple value risk questions. The second exam has some pretty rough value risk questions, but the first exam are just basic value risk. Make sure you got it. We'll get into those. All right, I'll stop it there.